For most of us, paying a monthly home insurance premium feels like buying an invisible force field. You set up the auto pay and assume your house, your apartment, and everything inside it is perfectly shielded from disaster. Because mortgage lenders and landlords usually require it, it's easy to treat this policy as an unavoidable tax on living, a box to check and immediately forget about. But that default piece of paper your broker handed you has hidden gaps. Standard policies explicitly exclude some of the most common ways Canadian homes actually get destroyed. We're going to tear apart a standard home insurance contract to locate those blind spots and show you exactly how to customize your coverage so it actually does its job. If you don't actively hunt for what your policy leaves out, a sudden disaster isn't what ruins you financially. The exclusions do. Whether you're paying $20 a month for a basement apartment or $300 for a detached house, your standard coverage is built on 4 core pillars. This grid maps the foundation. Up top, dwelling coverage rebuilds your home structure, and personal property replaces belongings like furniture. On the bottom, personal liability protects against injuries, and additional living expenses covers hotel costs if you're displaced. These 4 areas are highly effective at handling sudden, accidental emergencies, like a kitchen grease fire or a break-in. Assuming this 4-part foundation extends to every type of natural disaster is a dangerous financial mistake. Standard policies deliberately carve out the most severe, predictable weather and infrastructure threats in the country. Take a look at this aerial view of downtown Calgary underwater. Overland flooding from rivers or heavy rainfall is the costliest natural disaster risk in Canada, and it is entirely excluded from your default coverage. The same goes for sewer backups. When municipal pipes overflow and push wastewater back up through your basement drains, your base policy will not pay for the cleanup, even though this is the single most common water claim in the nation. To close these gaps, you have to purchase add-ons known as endorsements. This means you must actively tell your broker to calculate the flood and sewer risk for your specific neighborhood and pay an extra fee to add that protection back into your contract. Your financial security is defined by the specific list of endorsements you choose to add to that baseline contract. Even if you have the right endorsements, there is a mathematical trap hiding in the fine print that dictates how the insurance company values your ruined belongings. This split screen compares a 5-year-old $1,200 TV. With an actual cash value policy, the adjuster deducts depreciation, dropping your payout to $480. With replacement cost, depreciation is ignored, paying the full retail price for a brand new TV today. Budget policies often default to actual cash value to offer a cheaper monthly premium. Accepting that discount defeats the whole purpose of having insurance, practically guaranteeing you will fall thousands of dollars short when trying to replace an entire home's worth of possessions. Having replacement cost coverage on paper won't help you if you can't prove to an adjuster what was in the house before it burned down. You need a home inventory. Take 15 minutes, open your camera, and narrate a slow video walkthrough of every room. Zoom in on the brand names of your appliances, the serial numbers on your electronics, and inside your closets. Upload that file to a cloud service. Keeping your only copy on a hard drive sitting on your desk means your evidence gets destroyed in the exact same event you are trying to claim. Adding the right endorsements and replacement coverage will increase your bill, but there are safer ways to bring your premium back down without stripping away your protection. You can cut costs by 10 to 20% simply by bundling your home and auto insurance with the same company. Installing smart water leak detectors often triggers another discount. And if you have a healthy emergency fund, raising your deductible to $1,000 or more will immediately lower your monthly rate. Finally, call your broker for a 15-minute review once a year. If you've updated your plumbing or if your city has improved its stormwater infrastructure, your risk profile drops, and your rate should too. You should treat home insurance as a dynamic, customizable financial strategy rather than a passive monthly bill to be ignored. It requires your active participation to truly protect your biggest investment.